Be with you. I think that tech has had a historic run in the last several years, and that those who are betting on tech are basically betting on the market because tech is at a historically high percentage of the overall market capitalization of the market. And it's basically, you might as well buy an index fund at this point. The tech is so heavily weighted to that. I wouldn't reduce significantly any tech positions, but I would be looking heavily at some underloved, underappreciated stocks that have been left behind by the market, including some midstream oil and gas stocks, which have very high yields, much, much higher than treasuries, and are completely unloved and unliked and have better balance sheets than they have in quite some time. So I would be flexible if I was an investor at this point in the market. We're in the summer doldrums. We've had a small summer rally, and that's been nice while it's lasted, but we're going into the fall, which is a historically weak time for the market. And it's a good time to kind of just be reflective and make sure you're positioned the way you want to be.
Okay, so George, you're down in oil country, oil and gas country, coming to us from Dallas, I understand. And you mentioned those oil and gas names, and I thought you were kind of bearish on the sector. I was looking at XOM, for instance, which has this tasty 4% yield, right? But you lost 25% of your value over the past 5 years. The stock's gone from 100 to 75. So how do you play it?
Yeah, you play it with midstream. You play it with the infrastructure, which has got enormous yields and better balance sheets and completely unloved. So your margin of safety is much better than it used to be. The large integrateds will probably do okay going forward. We all know past performance is no indicator whatsoever of what future results are going to look like. I would not play the upstream. The upstream has the highest reward potential, but also the greatest risk. So I would play it safe with midstream and earn a big dividend until they come more in favor. But going back to tech, tech is dearly loved, whether it's old tech or new tech or any tech in between. And if you've had some nice runs with those, I wouldn't necessarily take gains, but I wouldn't overweight that at this point.
Hey, George, Brian Chung here. So, I mean, on that point, there's a lot of hot names that are in the field right now. Obviously, you've got the big ride-sharing companies, Uber and Lyft. Beyond Meat is the one that seems to catch a lot of people's eyes, especially ahead of their earnings later today. I mean, how do you make these plays on these type of IPOs, or do you really just try to wait until the dust settles on the price discovery as kind of more players get into the mix?
I think if you like to gamble, that all those stocks in Tesla are wonderful ways to roll the dice and see if you get lucky. But I'm not attuned to gambling in the stock market. I like to make seasoned decisions based on substance, and almost none of those companies are profitable. And so you're betting on the future completely and things that might happen over a great period of time. If you're going to own those stocks, I would buy them when we get a significant market correction and they're hopelessly out of favor, and add to positions then. I wouldn't be chasing them when we don't really know what they're going to look like yet and when they're the hot dots, so to speak.
Jared Glickry here. We've been talking about the everything rally. We got stocks going up, bonds going up, dollar trending up, gold, silver. What's the risk here of this being a really crowded long play? Are you concerned that this will unwind in any way? And if so, how?
Well, you know what they say? They say that the market can stay irrational a lot longer than you can stay liquid and able to play the market. So I'd be real hesitant to bet against the market. There's been a lot of very smart people trying to bet against the market for a very long time at this point, and they've either been carried out or they're singing the same sad song and being wrong and wrong again. So I'd be hesitant to be really super bearish right now, but I wouldn't be overly bullish either. It's a historically long bull market. It's time to be a little more prudent and cautious, and not necessarily dramatically reduce exposure, but reassess your exposure. Make sure you're not so aggressive that you could get hurt pretty badly if we do get a correction at some point.